Welcome to another edition of Focus on Alternatives, sponsored by ADISA, the Alternative and Direct Investment Securities Association. My name is Greg Moz. I'll be your host today, and we have Bill Shopoff with Shopoff Realty Investments. And Bill, to get us started, can you walk us through what is opportunistic investing, what is value-add investing, and what is more income-based investing when it comes to real estate?
Certainly. Appreciate being here. So opportunistic investing would be something on the higher end of the perceived risk spectrum, typically in the 18 to 20% internal rate of return and up. And it's generally defined as something where there is an opportunity to create value that doesn't exist otherwise. I call it making the invisible visible, which is somebody goes by a piece of property every day, sees one thing there, and then along the way, another developer goes by and sees something completely different and goes and seeks a rezoning. Maybe he saw an industrial facility there, but really what he saw was a future residential community. He goes, buys that site, he gets it rezoned, and then he either builds it out or sells it and achieves what I would think would be more opportunistic types of returns because he sought out something that others didn't see. They weren't looking at it for the income stream of what was there. He was looking at it for the income stream of what could be there. Mm-hmm. Value add is something where somebody's doing some improvements to a property. I would call it a heavy lift to a property. But perhaps they're buying an older apartment building and renovating it, in getting significant increases in rents. The terminology we use is, is there a classic unit or an upgrade unit? A classic unit is a nice way to say, is it that dumpy old unit that was built 30 years ago?
Right.
And the upgrade unit has got the new countertops and the new vinyl tiles and, cabinet fronts. And an upgrade where people would pay perhaps, they might pay $100 or $200 more a unit a month. So a developer might go spend $10,000 to renovate a unit. If he gets $150 a month, it's a pretty good return. That's going to put him in more of the value add space. And I would say typically I would put the value add space as kind of a mid-teens, maybe 12 to 16% internal rate of return is where the industry kind of sees that space. And then core or really income focused is single digit IRRs. It's buying that Class A building, typically in a major market, not always, but typically in a major market. They're buying a relatively new building, mostly new. You can have Class A with age on it. There are some Class A graceful office buildings. But I think generally people are thinking of that building as something that's newer vintage. It's got the right floor heights. It's got the right electricity if you're an office user, because today office use is much higher electric consumption than it used to be. But those investors are typically seeking an internal rate of return that's going to typically be in the single digits.
Thank you for walking us through that. There's a lot of the investments and funds that I see out there more focused on core, the core investing that you kind of just walked through. But your specialty is more in the opportunistic and value add. Can you give us some further examples of what those properties and or situations would look like? And is it dependent upon an asset class or geography?
Well, I think that's a great question. I think that it works across the asset classes and geography, but by virtue of it being opportunistic, it's not like I walk into my office every morning and there's a plethora of opportunities. You have to dig through a lot of things to find that gem. And so somebody that was focused on this space is going to look at a lot of opportunities, a lot more than it would take to go buy, not to pick on them, but if you're buying triple net lease deals, it's relatively straightforward business. You've determined what your credit risk that you're willing to take and in your lease duration, and then you want to yield. You find a property that meets that, say, I only want 10-year term, I only want Walgreens credit, and I want a 5 cap. And if those deals show up, you're a buyer. Mm-hmm. Well, the opportunistic business is a little different because I call it story investing, where when a broker calls, there needs to be some kind of story. Why is this for me? And why could I or some other sponsor solve the problem and achieve that 18 or 20% IRR instead of investing in safer things and making that, 8 or 10% IRR.
So as you come across these deals, how are you evaluating the risk of any given deal? I mean, how are you looking through that story, as you mentioned, and sifting through and saying, oh, that could be a good story that's going to have legs, and that one, we're just going to avoid that story?
Well, I think you've got to look at both your upside. Look, if you're doing an appropriate underwriting of an opportunistic deal, you get the upside pretty easily if you've got a decent deal. Now it's how do you figure out how to protect your downside? So maybe that's buying what we would call a covered land play, where I'm buying something where there's an existing use, where I'm at least covering downside, or at least most of my downside, but I've got a substantial upside from the change in use. That might be a good risk mitigating factor, but I think the other way to do it is by building a portfolio of assets, by not going on and saying, great, I got this one great deal, and I want to bet all my money on that one great deal. I think that's just not the way it should be done. I think you build a portfolio of assets, whether they're core assets for that investor in core, but for us as opportunistic investors, we think you've got to have more than one to create a portfolio, and then you want to allocate your capital appropriately across that portfolio. In the event that one of your ideas doesn't hatch, you're still doing okay.
So Bill, financial advisors, broker-dealers, registered investment advisors, they believe in growth, they believe in diversification, but what advice could you give them on how they should evaluate or pick a real estate manager that's focused on opportunistic investing?
Well, I think as part of their diligence, and they should run diligence in any advisor, any sponsor that they're going to do business with. But as part of that, they should be looking at track record. And I think part of track record is, does that sponsor have longevity through cycles? Have they managed through one or more cycles, and they're here to talk about it today? I think the other part is, did they learn, maybe you could focus when you were questioning them, pick what deal did you do that went great and tell us everything that went great, and then what deal did you do that didn't go so great, and what did you do about it? Maybe what did you do to mitigate your loss? Maybe you lost less, and what did you learn from it? And I think those are good questions. Look, it's not like real estate is a perfect science. Even core investors could lose money. And I could point to a number of examples of really smart money losing money on what were perceived to be safe investments. Mm-hmm. But clearly in this space, things do not always work to perfection. You count on doing some things and they're all not necessarily within your control. So then I think it's what did they learn from their mistakes, and how are they going to manage that going forward? Did they adapt to it? Did they change their leverage components, other things that work in their business, so that they'll be better geared towards a recession or some other blip in the system that they have to manage through?
Thank you. Opportunistic investing generally has a little bit more risk associated with it. We spoke about kind of mitigating some of that risk by investing in a portfolio of deals. But getting down to a specific per deal basis, what are some of the tools or tactics you use to mitigate risk on a per property level?
Well, I think it all starts at pre-acquisition diligence. Much like the sponsor doing, the rep doing diligence on a sponsor, mm-hmm. We spend an exorbitant amount of time doing diligence on each asset. We understand the asset, we understand the physical properties of the asset, whether there's environmental issues, what the geology might be, what land use issues are. And then we evaluate our primary business plan. I use the analogy, once upon a time I was a flight attendant on a corporate jet fleet. And so when I get on an airplane, I actually still look for the exits. My intention is, like yours, to go back out the way I got in. But, in my real estate deals, I look for alternative ways to get out of them. And sure. So maybe we buy an office building that we think we're going to rezone as condominiums, but we can't get that done. So we got to do the lease up on the office and sell it as an office building. So we want to know more than one way to get out of a deal, not just the way we're thinking about getting out of it. And I think that's what any opportunistic or value add investor should have is multiple departure strategies should the original plan not work.
Makes a lot of sense. Bill, thank you for walking us through some of these details when it comes to opportunistic and value-add real estate investing.
Happy to be here. Thanks for the time.
And thank you for watching another episode of Focus on Alternatives. For more information about real estate investing or alternative investments, please visit adisa.org. Thank you.